Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is part 4 in a series of articles I'm doing on reviewing and looking for fair value or investable value over all the various sectors as covered by FactSet Research. The consumer non-durable sector is really kind of an interesting one. I've got 11 research candidates that I'm going to be covering here. But the thing about the consumer non-durables is these are companies that are selling their products on a repeated basis. In other words, a food stock, for example, you're going to be buying every day. A company like Altria, which is the original Philip Morris, you would be buying your cigarettes or your tobacco products virtually every day. So they're companies that, the fact that their products are non-durable means that, they don't last a long period of time like an automobile or a house that I covered in my previous article. I'm going to go through 11 companies here, and again, I'm just looking at valuation. So as I pointed out in my last video, these are very cursory approaches I'm making here. I'm just really looking at these companies on the surface and providing an opportunity for those of you who find any of them interesting to go ahead and do your own more comprehensive research and due diligence. So let's start out by looking at, I'm going to do it in alphabetical order here by company. Let's start by looking at Altria. Now, Altria's symbol's MO, by the way, which is the old Philip Morris. And I want to point something out. This company also owned things like Kraft, and they owned Philip Morris International, which is one of the companies I'll be covering here. They spun these companies off. So when I'm looking at this particular stock, now the company that's called Altria with still the old original symbol MO, which was originally for Philip Morris. This is the only place I'm analyzing this stock now because this is the company as it exists today. And a couple of points I want to make here. The operating earnings growth of this company you can see is very consistent. That's the orange line on this graph. You can see that it's increased at a rate of about 8.7% since it's become the current configuration. I also want to make something else clear. When the price is touching this orange line, I consider it fairly valued. When the price is below the orange line or the blue line, it could change with different companies, I would consider it undervalued. And of course, when it's above it, I would consider it overvalued. Now, Philip Morris is really a very high quality stock. It only has 29% debt to capital. It's been around a long time, since the 1800s, but not, of course, in this configuration. But I want to make it clear, I would not have recommended this stock in 2017 here, May of 2017, or March or April or May of 2016, etc., because I considered the stock overvalued here. Now, there were several years of good performance. So let's assume that we bought it in the beginning of 2014 when it was trading at almost a 20 PE. Had you held it for that period of time through yesterday's close, you'd only made 4% a year. And this was during a time when the company was growing at about double that rate and even higher, 8, 9, 10% rates if you look at the bottom. Valuation is important. Had you bought it when it was trading at fairly valued, even though it's undervalued today, you would have made almost 12%. And of course, that includes dividend income. The point being is that all these research candidates are all about buying good businesses, but buying them when the valuations make sense. I think Altria makes a lot of sense now. Looking at it from a future point of view, it is expected to grow at about 6% a year. There are a reasonable amount of analysts, 18 analysts forecasting 5.76% growth for this fiscal year ending in December of 19, about 7% in 2020, and then followed by 5%. So if this traded at a normal 15 PE, there are some really nice rates of return to be made here, and the company currently offers a current dividend yield of 6%. So that's very attractive. I also want to point out that since the stock was undervalued at the beginning of this time frame, I'm using 2010 here, if you look at its historical performance, it would have actually outperformed the market significantly. And this is something that I want you to notice with most of these stocks on the total dividends paid. It not only has a much higher yield than the market at large, and that was one of the points I made in the write-up. Focus on the valuations of your individual stocks more so than the market. Generated, triple the dividend income that the market did. Pretty much a dead heat tie as far as capital appreciation, but as a result of the extra dividend income, you would have made a significantly better rate of return, annualized rate of return of just under 15% versus 12% for the market. This was also a good time for the market. But the key point I want to make here, and it's something I think you're going to see commonly throughout this, is the idea of the excessive amount of dividend income. So moving on now, let's move into a pure food stock, ConAgra Corporation. ConAgra Brands is an interesting company, but slightly different than Altria. For one thing, I want you to notice there's a lot more cyclicality here. It does offer a current yield of about 3.9%. It has a lot more debt. It is triple B minus rated, however, which is only a slightly lower rating, but it has a relatively spotty dividend record compared to what we saw with Altria. You know, they have had periods where they cut their dividend in the past. They cut it quite recently in 2017. The company has a May fiscal year, by the way. But I do want you to notice that the price goes where the earnings go. The key element here is that it's a reasonably stable business with a good, dividend yield, although the dividend record is not consistent or even pristine. But again, if you buy these stocks when they're undervalued, you can go through periods of time where you make decent money. ConAgra has become significantly undervalued, in my opinion, and the forecasts for growth going forward are about the same as we saw with Altria a moment ago. So if it were to revert to the mean, you could have 30 and 40% rates of return over the next year or two. Remember now, they have a May fiscal year, so their fiscal year for 2019 ends in just a few months. But again, ConAgra Brands is another interesting company in the consumer non-durable stocks that appears to be extremely undervalued today. However, I want to point out, know the businesses that you're investing in. It has a very spotty and inconsistent record of operating performance as well as dividend performance. And I don't know actually what the beta is because I personally don't measure betas, but just by looking at this graph, I can see that there's a lot of volatility in this stock. Now, similarly, I'm going to move on to another company that's in a similar business as ConAgra, and this is Campbell Soup. And once again, you see a reasonably high dividend yield, 4%. Company does have a lot of debt. Their dividend record, again, cut their dividend coming out of the recession of 01. Their dividend record is a little choppy, but their payout ratios remain reasonably consistent in the mid 40s to even as high as 50% range. So again, the key is when you're looking at a company like this, you're really looking at it for the yield. So if I look at this stock, you want to be careful about your valuation here. Back in 1998, it was significantly overvalued. So I want to get rid of that anomalous valuation and look at it over a period where valuations are normal. And here's where you see the advantage of investing in a consumer non-durable. They generated significantly more dividend income when valuations were reasonable, but they underperformed the S&P on a capital appreciation basis, and they underperformed it on a total return. As I pointed out in the video, you don't get rich owning these stocks. This particular company is not expected to grow very fast. Its historical growth rate, I want you to notice, has only been 2 or 3%, depending on what time frame you measure it by. Here you got 1.7% since 2010. So this is not a fast-growing company. It's all about buying it for the dividend income. And, you can generally expect it to generate more income than the market, but capital appreciation might go wanting in a stock like this. But this is what investing in a stock like Campbell Soup can do for you or will do for you. It is reasonably cheap right now, but again, it doesn't have great prospects for growth. So don't just look at low PE ratios and high dividend yields. The next example is General Mills, and this is one that I actually have a position in. I'm buying it strictly for the income. It has a little better dividend income record than we saw with the previous companies I've shown so far, excluding Altria. It's got a good dividend growth rate, about 7 or 8%. It's historically increased its dividend consistently. The company got ridiculously overvalued in 2016, and it made no sense, but it happened, and that's something I think investors really need to get a grip on. You never can tell what the market would do. This made no economic sense whatsoever for this stock. The growth rates were not that high. The dividend yield was not that high. If I look at average dividend yields here, when the stock was trading at its peak valuation in July of 2016, and again, this has a May fiscal year, it was only yielding about 2.8% at that time. That's half of what it's yielding now when the valuation is low. So again, this would be a great opportunity to invest in this stock for its dividend yield with very low growth. It's all about investing in the income here. And my point is, when you make an investment in a stock like this, know what you're investing in and why you're investing in it. This is strictly about the dividend income and the reasonable amount of stability that comes with investing in a cereal company like General Mills. Moving on here, when I look at another cereal company here, we can look at Kellogg. We have a very similar story, a little bit better growth, a little bit better dividend record. And again, I want to get this down to a point where the valuation at least was reasonable. If I look at it from a performance point of view, it will produce more dividend income than the S&P, but again, underperforms it on a total return basis and underperforms it on a capital appreciation basis. Again, this is all about investing for the dividend income when you're investing in these lower growth consumer non-durables. Forecast-wise, very low growth expected going forward. So this isn't about making a lot of money or getting rich. It's about earning a reasonably high current dividend yield at an attractive valuation. So again, it could be a place to park money more than it would be a place to think about getting rich or trying to make a great deal of money. My next research candidate would be actually Philip Morris International, the company that was spun off from Altria that I pointed out earlier. You can see it was spun off in 2008. That's when I was, really measuring the performance of the current Altria right now. I do want you to notice the importance of valuation again. The stock got significantly overvalued in 2017. It's reverted to the mean. It's now reasonably valued with a 6% dividend yield. Forecast growth is about 7 or 8%. So this could be a double-digit return performer, assuming it, trades at a nice, respectable 15 PE ratio going forward. Performance-wise, it generated significantly more dividend income than the market, kind of held its own, slightly underperformed the market on a capital gain basis. However, on a total return basis, it actually outperformed the market thanks to the generous dividend. The next company I'm going to look at here is PVH Corporation. Many of you may not recognize or identify with the name PVH Corporation, but most of you will identify with their brands. They own Calvin Klein, both North American and international. They own Tommy Hilfiger. They own Heritage Brands and Heritage Brands Retail. So it's a company that's well known for its brands in the apparel industry. This is much more of a growth stock. It's one of the exceptions to the rule that I mentioned in the article. You can see that their operating earnings growth has been quite strong. It's averaged over 14% since 2004. And I want you to notice how the price really tracks that. They do pay a very small dividend, almost none. Their dividend yield is 1/10 of 1%. So this is truly one of the few or the only growth stock that I've included in this portfolio. And I do consider it significantly undervalued. I want you to notice how when it got overvalued, it had a strong reversion to the mean and then overreacted to the downside. But notice how the stock is beginning to move back into alignment with that orange justified valuation line again. So PVH is an interesting company. It's forecast to grow at double-digit rates going forward. Consequently, this is not an income vehicle in contrast to what I've shown you thus far in this sector. This is more of a capital appreciation, and so you can find that even in this sector that's more known for its stable dividend-producing stocks. The next company I'm going to take a look at is J.M. Smucker. I've talked about this one before. This is one of the better food stocks in my opinion. They have a decent growth rate, almost 9%. You can see when valuation got extended that now the stock is trading at a reasonably attractive valuation. However, earnings growth is expected to be rather low for the next couple years. So you've got to take all these things into consideration. This is a 5 or 6% return investment. Again, primarily attractive, I think, for its dividend income. If you look at long-term performance, it dramatically outperformed the S&P on total income as well as capital appreciation and as well as total return. But I want you to understand how that happened. That happened because the company was reasonably valued here at the time frame being measured, and the stock price certainly tracked the operating history of the business. And even though it's undervalued now, it still was an outperformer. This is a decent company that can be bought at an attractive valuation with a decent dividend yield, but again, it's not going to necessarily make you rich. My next research candidate is Molson Coors Brewing, obviously a beer company. And again, I want you to see the similarity that we've looked at with other stocks here. We have about a 2.5% yield. We saw very high valuation just a couple of years ago. This has been a recurring pattern with these food stocks here. When I look at long-term performance, outperformed the market on the dividends produced. It performed pretty decently or, close to the same. It came out in almost a dead heat. But I do want to point out the stock was moderately overvalued there. If I chop a couple of years off of here and look at it when valuation was in a line or slightly undervalued, then we get a slightly different story here. It actually underperformed the market and paid a dividend yield that was just about equal to the market. but that's primarily attributed to the fact that there was not a lot of growth and the fact that the stock is currently undervalued right now. So there's Molson Coors, has a decent dividend yield, 37%, triple B minus rated. My next example is Tyson Foods, primarily known for their chicken, but they do other food products as well. Again, you don't see a lot of growth. These aren't the kind of stocks, these aren't your Starbucks or your Apples or your, Facebooks or your very powerful growth stocks. However, if I look at Tyson Foods since coming out of the Great Recession, it does have a double-digit growth rate, and you can see that the price has tracked that. It's currently undervalued, forecast to grow at about 5 or 6%. If it reverts to the mean, the undervaluation is what makes this attractive here. It has an above market dividend yield, but the real key here and the real attractiveness would be the undervaluation. Its dividend income is about equal to the market over this time frame, slightly outperformed the market on a capital appreciation and a total return as a result, but that had more to do with the fact that it was undervalued during this time frame. I want you to notice as you change different time frames, you can get different results. Here you have about a dead heat with the market on dividends, capital outperformance, but again, all this capital outperformance came as a result of this growth period that I had highlighted here a minute ago. The stock is undervalued and is starting to look like it's headed back to its more normal 15 PE multiple going forward. My next and final candidate in this group is Kraft Heinz. Kraft Heinz is one of the other spin-offs from Altria or Philip Morris. I do want you to notice that this stock has had a legacy here in its short operating history going back to 2012 of being very overvalued. So if you look at it from the beginning of 2016 to current, it's been what could only be classified as a dog. If you'd have bought it at the valuation in December of 2016, you'd have lost almost half your money, and your analyzed rate of return would be a negative 21% a year. But what has changed here is that the stock now is reasonably valued. It's not forecast to grow very much, which is common. It does offer a 5% dividend yield, and therefore it does offer the opportunity to have double-digit returns out for the next couple of years. Long-term growth is a little better at 3%, but again, if it reverts to the mean, this could be double-digit rates of return because it is a quality company that's currently on sale. And again, a spin-off from the original MO Philip Morris that morphed into Altria, that also spun off Philip Morris International and also the Kraft Heinz companies, as well as Mendelez and others. Anyway, this has been Chuck Carnevale taking a look at the consumer non-durable sector. Not a lot of things to be excited about here, but yet good companies that can give you decent incomes if you're careful when you buy them. I would obviously, as I always do, recommend that you conduct your own research and due diligence, but hopefully there's a couple of names in here that might be attractive to you or names you hadn't considered before. Thanks for watching.